All right, everybody, welcome back. It's episode 103 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, the third part of our series at the Canadian Mortgage Summit here in Toronto.
3 coffees deep.
Couple coffees deep, couple Diet Cokes, and we just had an awesome guest, Mike Forshee, president of Glass Lake Funding.
Guy's a beast.
These guys are doing some big time stuff. This is a really cool interview. I didn't realize how big they have become in just 3 years.
Every interview, his conversation was in millions, and then he kept using the term billion. So
they're up in the B's now.
They're up in the B's.
It's pretty cool to see. He shared with us, not only over $1 billion in assets under management, but also some 9-digit deals closed, single deals over $100 million. So really cool milestones for them to have hit.
Unbelievable for uninsured mortgages to be that size.
Absolutely. And it's it kind of gives us a peek into the future of how maybe Canadian lending is going to continue trending towards. Some of the other interesting things they had, longer terms as well, where they started off with 3-year terms exclusively, which is very rare in the alternative and private space, which is typically 1 to 2 years.
Yep.
And also they're focused on minimum credit scores as well, which probably lends well in their business, but they do have a minimum of a 650 credit score for any of their borrowers as well. So very unique things, very different than a lot of the mix and private lenders that we typically chat with.
Yeah, 100%. Another thing that I found that was really different is every MIC we speak to talks about turnover, getting the loans recycled, and they talk about kind of wanting some stickiness, wanting renewals, wanting longer terms, like you said. So, anyways, really interesting fellow. Very smart.
A bit of a hybrid approach versus a lot of other lenders. But anyways, hope you guys enjoyed the interview with Mike from Glass Lake.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal Andreino and Ryan McNeil. Enjoy.
We are here with Mike Forshee, president of Glass Lake Funding. Mike, great to see you, man.
Yeah, great to see you as
well.
Thanks for the invite.
Absolutely.
Really appreciate it.
Absolutely. So Glass Lake, relatively new entity, relatively speaking, I guess. You had mentioned you guys are coming up on 3 years now, but before we kind of dive in on Glass Lake, I'd love for you to take a step back, kind of give us a bit of information about your background. I know you spent some time with Home Trust in your past, and just want to hear about how you landed in the mortgage space and what led to Glass Lake.
Yeah, I'll take you back right from the beginning. So I've been lending or in the lending arena for 25 years. Actually fell into it completely by accident. My brother was playing professional hockey in England. I didn't know what I wanted to do after university, so I went over there. We're able to work in the UK because my grandmother's from there, and ended up taking an entry-level mortgage advisor role at Nationwide Building Society. So Building Society is like a large credit union, and spent 2 years in the UK. Then came back to Canada, had a stop at ING, ended up at a startup, CLN Highlander, which was providing closing services and title, and then moved on to Home Loans Canada, which was a division of CIBC.
Yep.
And from there got to know Home Trust and made the move to Home Trust in 2004. So I was at Home Trust for about 18 years, started as an underwriter, worked my way up. My last role was executive VP of underwriting and servicing and funding. And then this opportunity came about. So it seemed like a great opportunity given the time in the market. So Bayview Asset Management, which is Glass Lake's parent company, was looking to start a Canadian operation.
Yep.
I was one of the lucky people that got contacted to be part of the process. And I joined Bayview in January 2022 to start what is now Glass Lake Funding.
Amazing.
Okay, first thing that popped to my mind is there a notable difference between the way that they do lending in the UK to Canada? I mean, it's been some years or whatever, but is there something extremely different in any of the way that they operate?
There are some differences, but I would say largely it's pretty similar to Canada. But I think outside of rules and regulations, just the philosophy of lending, right? And I think not only that, the clientele in England are very similar to Canada, where they like to pay their bills. I mean, it sounds funny, but part of Bayview's thesis of coming into Canada was they're a global hedge fund, or we're a global hedge fund, but they can easily see through data that Canadians pay their bills better than most people around the globe. And the UK was quite similar in some of the performance data.
Interesting. I didn't realize that was, we ran a higher credit profile on average in Canada than other parts of the country, or world, I guess.
Yeah, I think, data is so hard to come by in Canada. Like,
Yeah.
in the UK, in the US, it's very freely available. But for the data we can get our hands on in Canada,
Yeah.
the Canadians are much more, especially when it comes to mortgages, they're more responsible than,
Okay.
I don't know if responsible is the right word, but they're more,
They pay their
their
mortgages.
bills. Yeah, on time.
Yeah.
And there's this ongoing debate between myself in Canada and my parent company in the U.S., which is, why is that, right? And I think I go back to, I think it's just ingrained in us Canadians to pay our bills. But there's also this fact around recourse loans versus, in many states in the U.S., it's non-recourse, and how much does that play into it?
Sure.
Yeah.
Makes sense.
That's something I've always noticed with like media is that it's like, and you see it still now. People go bankrupt on a loan, and there's no, people can't fathom that here. Like, if you go bankrupt on a loan, you're personally guaranteed on it, no matter what it is.
That's
Whereas
right.
in the States, again, there's non-recourse, which is
Correct,
a
yeah.
totally different mindset.
Yeah,
Definitely.
cool for you to get the different perspective, having worked overseas and being connected to the U.S. as well. But I also want to circle back on your brother playing pro hockey over there, but maybe we'll leave that for the end of the pod here. Let's dive in on Glass Lake. So, you guys, we've got to know you a little bit through the last couple of years, but you guys are very different than most private or alternative lenders. I don't know. Do you guys consider yourself a private lender? Is that the way?
I don't know. My running joke is we don't identify, but I don't know if that's a joke, but I think we're private in the sense that we're not federally regulated in Canada.
Sure. Yeah.
We're provincially regulated. I think our governance model looks very much like a regulated entity, but our lending products look very much private-esque, right? So I think when we started the business, the goal really was, especially where I came from in home capital, you could see the fallout that B20 was creating, and consumers having to slide down the kind of credit scale. But to me, there was this missing middle where you were either going from the regulated entity into the private market, and there wasn't much else in between. So our goal was to kind of come in and be that in-between stopgap. So as people fall out of the B20 regulated institutions, we're a stopgap before they may have to go to private.
Yeah.
And on the way out of private, because clients weren't graduating as quickly back up into the regulated entities, you can have a stopgap with us and then graduate. So we see that working, but we also see, our book's still pretty young. It's not that mature, but renewal rates are excessively high, which we like. Clients are taking longer-term mortgages than the 1 year, which we like. That's our model. But we're seeing the speed to graduate back up the curve, at least from our book, has really slowed down, which means people are staying with us longer.
I was going to ask you, how do you guys manage the liquidity aspect of that? And I guess, do you need to with Bayview? Because a lot of the other mix and privates that we talk to, they want the opposite. They want turnover of their loans. Versus you guys you're saying that you guys want to be able to keep and get people to renew and do longer AMs. So is that because of the fund source that you're working with?
Yeah, one of the great things about being part of the Bayview family is you get access to the diversified fund offering inside of Bayview. So right now, most of our loans, almost all of our Canadian originations go into the Bayview-owned life and annuity company. So given that it's a life and annuity company, longer duration's better.
Okay.
Long duration to us in Canada is like a 3-year term, which is still short to the U.S. So there isn't really a pricing mismatch from the asset liability side.
Yeah.
And there's ample liquidity in there. So the great thing about originating a loan into a life and annuity balance sheet is that it's just like clipping coupons. It sits there, client pays for life, the money's there, it's very low capital, like the capital adequacy is great, so you get nice margins on it, and the money seems to be always there. So there's no need to run these things off. We're quite the opposite, where we would rather get duration. Now, if I can just go on a bit of a story for a second, we took a lot of crap when we first launched in Canada, because our first offering was 3-year term only, and everyone's like, oh, how do you have a 3-year? Everyone needs 1 year. And then I think it was about 3-4 months in, a Globe and Mail article broke about how certain lenders were not renewing clients and forcing them into legal action. All of a sudden, the 3-year became very popular without us having to do anything. So we got a little help on that. But I would say on the residential side, average term we have today is about 26 months.
Okay.
On the small balance commercial side, we're now closing in on 5 years. So we're noticing, especially the owner-occupied small commercial, they want longer duration naturally.
And you were saying you're seeing higher renewal. Would you have a percentage of which of those would renew?
Yeah, like right now on residential, it's about 75, and on small balance commercial, 85.
Interesting.
Now, still not a mature book, relatively small numbers on renewals, but we are seeing people are opting to take them.
Interesting. So where you guys are owned by an asset manager, I'm assuming you guys don't have any mortgage investment corporation or mutual fund trust structure?
No, that's correct.
Yeah.
That's correct.
Okay.
Yeah.
Very
Yeah.
interesting.
And then do all the funds come from the asset manager then? Is it in selling out to these long-term annuities?
Yeah, so we have the life and annuity company.
Yeah.
We have other funds inside of Bayview that we could opt to use, but I think the cleanest, most efficient funding for us at the moment is the life and annuity company.
Okay.
I think as we grow, we'll have continuous conversations internally
Sure.
about whether to diversify across the asset set
Yeah.
or the funding set. But right now, the life and annuity company is very happy. We're happy
Nice.
having that access to it, so it just seems to work.
Nice.
So you kind of touched on it a bit there, Mike, about you guys being involved, and you do res, small balance commercial. I know you do some larger commercial deals as well. Can you kind of touch on your loan types, or the different avenues you go down in terms of lending territories, kind of client profiles? Like what's the ideal fit for you guys?
Yeah, like I think when you start on the residential side, it's we don't do equity loans. We like to view some affordability, so we get 6 months bank statements on the client. So it's really the client that has just missed the B20 mark, can't qualify. We don't go below a 650 FICO score. There's a lot of reason for that. I know in my experience in my previous life, you see a complete drop-off in performance below that. Some of the data we analyze shows the same thing. I think we're into some economic headwinds in Canada, so we wanted to create a bit of a moat there. But it's really the self-employed individual, someone who's tight on on debt servicing due to the stress test. And what we're seeing a lot of now, both in the residential and small commercial bucket, are clients that have hit concentration limits at the banks. So really well-heeled clients, really strong, significant net worth, but they've just hit a lending cap at the bank, so they're coming to us. So we're seeing a lot of bigger ticket loans. We just completed on a $5 million residential, $7.5 million residential. We have an 8.5 in the pipe. So those clients have been, we didn't bank on that being a core client, but it's been a nice opportunity that we found.
Yeah, so you're really, you're not focused on that damaged credit delinquent type client at all.
No, I think that was never in our ballpark. Like I think we just want, again, using the life and annuity company, our view of the market is there's a lot of opportunity in the Canadian market for those clients that just miss B20.
Yeah.
I didn't want to start especially building the business from scratch.
Yeah,
I didn't want to start a portfolio with deals that were going to start blowing up the portfolio.
Yeah,
right.
Absolutely.
So do we go outside of that or below that 650 range? You bet you, but there has to be mitigating factors.
That's what I was going to ask you. Sorry, Neal. I was just wanted to finish my thought because I noticed the 650 minimum on your website, and that caught my attention in that a lot of private lenders wouldn't advertise a minimum credit, right? Or with 650 is, you could argue, average to
Yep.
decent, right? So is it just what you've seen from the data historically that's kind of the magic number, or like you said, you do dabble in some exceptions if the other things fit in your bucket?
Yeah, I think, well, first off, we don't want to give anybody who's wanting to use us a false narrative, right? So we want to be pretty upfront. We do see from the data we have access to, there's a sharp drop-off in probability of default below 650. And I think what we were looking for more is someone who has the demonstrated affordability or can demonstrate they can pay their bills, but can't meet the other income requirements. So that was the target client. Now we still look at income, we assess affordability, but in no way did we want to A, take on someone else's problem, or B, be a stopgap to an eventual sale through enforcement. That's not the business we're in.
Got it.
So you mentioned, so those loans, you say 6.5, 7.5 million. Those are individual loans for one property?
That's correct.
That's an interesting marketplace. So those are people where they're clearly high net worth, probably very successful business owners, and they're unable to get the funding that they want to build their home at that point. Is there a large marketplace for that? Because I feel like very quickly you could run up a couple $100 million at loan sizes of that magnitude. Like 20 of those and you're at $150 million.
Yeah, that's right. I wouldn't say it's a large market. I would say it's a very opportunistic market that kind of found us, and it's getting out now that we're doing the larger ticket loans. So those are coming in, and but I think it's very unique, right? You look at some of those loans and they're chunky loans.
Yeah.
But you look at the clientele behind them, you go, how do I not do this deal, right? Like properties in great locations, usually well kept. They're not as rate sensitive because they know why they need the money. They know what they're leveraging the cash for.
Yeah.
And they understand their situation. That some of these clients have been lifelong private wealth banking clients, and they're like, what? Now I can't get a bank mortgage?
Yeah.
So they're just interested in accessing the funds. Many of them are using it for business purposes where they see a multiplier on the debt versus a 6% rate and complaining about the rate.
Yeah.
So it's very interesting. And if I can just go back to the 650 FICO for one sec, that's allowed us to do other things as well. We believe our geography is quite wide compared to some of the other people in the space. And I think by having a minimum FICO, it allows you to go into secondary and sometimes tertiary markets that others don't go to, but you've kind of put the guardrails in place to ensure you're not lending to everybody in every market.
Still chasing lenders for updates? Manually entering deal details? Are you a law firm still not able to perform a discharge with just a simple button click? Well, Lawyer Automator is the modern solution built specifically for real estate law firms working with private lenders. Eliminate manual effort and automate intelligent document generation and digital instructions between lenders and lawyers with just a simple click. Enjoy seamless communication across your entire team and all stakeholders involved in the deal, from clerks to partners and everyone in between. Get comprehensive end-to-end reporting with visual business intelligence tools right on your screen. Perform discharges at the touch of a button. And because we're connected to Canada's largest private lending network, we'll even help you grow your client base with exclusive networking opportunities. Lawyer Automator. Work smart. Close fast. Grow your business.
Interesting.
So expand on your lending territory. So I know you guys started in Ontario, and then I think you quickly expanded to Alberta and BC, or?
Yeah, we kind of did Alberta, BC at the same time.
Okay.
Not on purpose. I think that's just when the licensing landed. So, but yeah, we're right now Ontario, BC, Alberta, Quebec. In Ontario, we go quite wide. Like last Friday, I was up in Sault Ste. Marie and Sudbury.
Wow.
And we have a saying internally, which is secondary, not shitty, right? So there's a big difference between secondary markets and crappy real estate. Like there's a big differentiator.
Yeah.
And we were able to look at some data from, it's dated data, but of other lenders that went into secondary markets previous to us, and we could see a clear line of, I don't know if I should say it this way, but there's certain side of the tracks you want to lend on. And there was some bad lending decisions made on not so great real estate, so we don't want to go down that path. So really in secondary and tertiary markets, we're looking for well-maintained properties, pride of ownership, decent credit to make it work.
So to that point, with such a secure funding source, I guess all your focus is on gaining as much market share as possible. How are you guys doing that? Is it product offerings or pounding the pavement, being at events like this? Kind of what's your guys' best path to get the money out?
Yeah, like we have, it's a great question actually, because we've toyed around with a few things. We have a very small sales team.
Okay.
Extremely small. But coming to events like this, helpful, especially in the beginning.
Yeah.
We now have our new Wave Makers program, so if you fund X amount in a month, you get certain perks unlocked.
Yeah.
And then the ultimate qualifier for that is you get to go on a trip at the end of the year with us. But what we found, we track our data, all data, very, very closely. Our social media presence has driven almost 50% of our business.
It's everything.
Right?
Amazing.
And then even I was shocked by it. And when I first saw that stat, I was like, go back and relook at it because I wasn't quite sure. But for whatever reason, our social media has been hitting home with people. And then there's word of mouth, right? Like you fund a $7 million deal, that agent tells someone else. You fund a deal in somewhere north of Barrie, they're talking about it. You fund something that just no one else can do with a unique structure, the word tends to get out quite quickly.
Yeah, I'm glad you brought that up, Mike, because we talk about it all the time on this podcast, like the importance of social media. We've built Keystone on social media from day one. Big reason for this podcast as well was to get out there and promote the industry on social as well. And I've noticed Glass Lake since early on too. You guys have been doing it since the start. Another thing I find really cool about you guys is actually your colors.
Yeah.
So very unique in terms of the purple, and is it like a seafoam green or like a lighter green?
Seafoam.
To me, it's green.
Yeah. It really stands out. Like when you're at a conference or when you're online, it's something that you wouldn't normally see related to banking and mortgages.
Yeah, what's interesting, and Ravani was just here, our head of marketing, but when we first started the business and started building it, we were just Bayview Canada, right? And we knew at some point we would change the name. We didn't know what it was going to be. We came upon to name the company Glass Lake. What that means is take the chop out of the underwriting process, right? Like a nice smooth lake.
Clever.
Now in the beginning, we probably added more chop than took it out while we found our footing. But the color scheme. I remember Ravani coming to my office one day showing this color scheme, and I don't know, green's green to me, purple's purple. But that's really the brainchild of Ravani, and it seems to work. Many people comment on it.
Yeah.
It sticks out. I think it's a little bit different, but it's allowed us to carve out maybe a bit of a niche in the marketing side of the business.
You quickly touched on the Wave Makers program. What exactly is that, and how's that going?
Yeah, I think we can see it working clearly.
Yeah.
We can see it working. I don't pretend to know all the details in and out, but really, that was another idea by Ravani that she came up with. And it was like just for look, you can't build a business on a bunch of one-offs, right?
Yep.
Like we want new people to come in and use us, formulate their own opinion and start building on it. But what we do know is loyalty is the key. So we had to start rewarding the loyalty.
Yep.
And there's some brokers that were with us from day one when we were tripping over our own feet, and we were only 65% loan to value, not 80 like today. So we felt we had to reward them. So each month, it flips each month. So if you qualify for Wave Maker status in a month, which I believe the minimum threshold's $1 million and a half, so it's not huge.
Yep.
That's a deal in Ontario.
Yep.
Then you unlock certain privileges the next month, which is like rate discount, payment against partial payment of appraisals, etc. And then it just builds from there depending on how much you fund.
It's almost like a point system on a credit card for a consumer, but you're now doing it with a broker, so eventually you're getting them into your ecosystem.
That's right.
And they continue to build off of that.
And we find, it's still new to the broker network too. We have to reach out to some brokers and say, hey, you have these perks.
Yeah.
Use them or lose them. And they're like, oh, yeah, okay, here's the next deal. So, I find especially today with the cost of appraisals in some markets, most people are taking us up on the appraisal, the coupon
Coverage.
Towards an appraisal.
Very
Nice.
cool.
What you said the top prize is a trip?
Yeah, at the end, we take our top 10 brokers. This year it's Aruba, so top
sweet.
10 brokers will get to go to
Very
Aruba.
I guess we got to add something in.
Yeah, I guess so.
Exactly.
Mike, you mentioned chunky loans a couple
Yep.
minutes ago, and before we started recording, it sounds like you guys have hit some pretty major milestones in terms of commercial deal you recently did and your AUM. So Can you talk about that?
Yeah, so on the AUM front, we're quite happy. We just passed the $1 billion mark. So in a short
congratulations.
period of time,
Really cool.
we're pretty excited about that. And we feel we've done it the right way, right? We didn't rush in and try to be everything to everybody and take on every piece of business. We felt we took a very disciplined approach to it, and the performance has been great. On the heels of that, we launched our large commercial business recently, kind of at the tail end of 2024. And we just we provided funding on a $100 million loan, single advance. So that was another big milestone that we're really excited about. Yeah.
Yep.
So I mean, we're just, we're looking to build on that, right? And I think, we have something different in the market, we believe, and we're just looking for new opportunities.
How do you manage risk on a $100 million loan?
Well, it was a tight timeline as well, and there were many sleepless nights. But I think, I do have to give a shout out to the Glass Lake team and just to the Bayview team as a whole. The commitment level from everybody involved in that deal to get it done was nothing like I've never seen it before. Everyone coming together. There were, there's a lot to uncover when you're lending $100 million and a lot to go through. And everyone was really committed to seeing it through to the end. And, things popped up throughout the process, and everyone just kind of held hands and worked hard to find the mitigating factors. And we think it's a very strong deal and one that will lead to more deals of that size.
When you guys land on a deal of that size, I guess there's a comfort level because of where the capital's coming from, that if you need to reclaim that, you might have to take it on for a period of time before you can liquidate that or pass it on to the next eventual user or whatever it is if it's development.
Yeah, we stress we stress all of our deals in different ways, but a $100 million deal, you stress every outcome.
Yeah.
And your base case is probably your worst case, and your worst case probably beyond the worst case. But we feel quite confident in the asset that we lent on, the sponsor, and the administrator who's admitting the loan for us. So we'll see that one through.
Do you think you want to do more growth in deal sizes like that compared to the $1 million deals, $2 million deals?
That's a great question. I think when I sit here and just think about it, we just want to do good deals, good business, right? If you look, our minimum loan size, $200,000. We just completed $100 million. That's a lot in between. Sure. So we just think if we, on the residential and small commercial stuff, which is more process driven, as long as we stay disciplined, I think, which I believe we will stay disciplined, build a nice little book, and there'll be lots of opportunity. On the bigger stuff, those are more opportunistic when they come in. You don't see a $100 million deal every day of the week, right? Sure. So, we're definitely comfortable playing in that space. It's just making sure we like the asset, we like the sponsor, and we understand the downside scenario very well to know if something does happen, we know how we're going to mitigate it. Yeah.
That makes sense.
Do you feel you're going to just, in terms of growth plans, are you going to continue down this same path that you're on right now? Or are you going to be introducing new products? Are you going to focus more on the commercial side and the bigger deal sizes, or a multitude of those?
Yeah, we've been having a lot of talk about that internally. I think to get to your first $1 billion, it can't look the same to get to your second $1 billion, right? So definitely stay tuned for new products in 2026. I think our operating model we're quite happy with. We're looking to add more people to the team. We run a pretty lean team, but I think running lean early on will allow for greater expansion in this kind of second evolution. But new products, and even some products outside of the mortgage space too. We're working on, it's very early stages, but our first auto portfolio deal.
Wow.
So there's a lot to come, and we're looking at products that we can just, because the clients seem to have, because the renewal rates seem sticky, we've got to find ways to offer those clients who stay with us other products that support what they need. So one thing, I'm not committing to this, by the way, but small business loans, given that a core profile of the profile of our core client is the small business owner, would be probably next on the list.
I have so many things running through my head, but I guess, so yeah, and maybe it's teasers or you're not prepared to share them yet, but what does that growth look like? How do you get there? And as you're saying, it's new products. Is there a segment of the marketplace or a region that you think that there's more growth opportunity? You guys you kind of mentioned auto. What's that look like?
I think auto would be a nice bolt-on to what we've done, but I think from growth, I still think when you look at $1 billion's a nice number, right? But when you look at the market size overall, we feel we've still not even touched the surface in certain provinces where we think we can go. So, going back to wave makers, that's step one in getting a deeper penetration into certain markets. But we definitely think we can be working closely with specific broker outfits to help drive that growth as the message gets out. I also think new lenders are coming into the market. That is fantastic because that makes the awareness of the segment wider, right?
Yep.
So I'm a big champion of new lenders coming in or new lenders who like to lend and understand the markets coming in because I think that's just better for everybody involved.
Are you a private mortgage lender in Ontario looking for trusted legal support? Meet Grecky Carter Professional Corporation, a boutique real estate law firm in Midtown Toronto with deep expertise in private lending and mortgage enforcement. Grecky Carter closes hundreds of private mortgage deals every year, and when recovery becomes necessary, they handle both contested and uncontested enforcement with precision, from forbearance agreements to power of sale and cost recovery strategies. For lenders who demand clarity, efficiency, and results, Grecky Carter has you covered. Visit gclaw.ca to learn more and safeguard your private lending investments.
It expands the pie.
That's right.
Sorry, another question coming to my head. Where you're saying there's a lot of renewals on people's homes, do you think that this becomes the new norm where, like, I feel like previously a generation would pay off their home and eventually have all that equity? Do you think now it becomes a place where there may always be almost a first position on people's homes to the point of their retirement and eventual selling, and they're just capturing the remaining equity that's there at that point?
Yeah, like to me, that's two different things. Like I think the renewal piece, it's sticky right now. Is it always going to be like that? I don't know. Like rates and affordability play into it. Do I see regulation loosening? No. So as long as when federal regulation keeps tightening, I think that missing middle that we kind of play in and a couple other new entrants will be the new home. Like I think when I started at Home Trust years ago, it was quite a small outfit, right? And then through regulatory change, it developed its own sub-market, and there's a lot of hard work done at home to capture some of that clientele. But I see this new missing middle as that new segment of the market that's missing that almost home and equitable filled 20 years ago.
Yeah.
And I think as long as more liquidity can flow into that segment, the clients may have more choice within the segment, but I still think it's going to continue to be tougher to graduate upscale. And then I think on the point about the mortgage always being there, in some markets I think it may, right? Like affordability, it's crazy. I always joke with my wife, like if we bought our property today in our neighborhood, we probably wouldn't be able to afford it, right? Like we've just happened to be there for 12 years. So, so it's tough, right? Affordability's, Canadians are pressured. So having diverse funding sources they can pull on, I think, is important. So like basically renewal is more a product of the current marketplace rather than a cultural shift in the way that people are going to utilize their home. Yeah, and I do think there's a bit of a difference between the residential and small balance commercial client, where the owner, like I mentioned earlier, the owner-occupied small balance commercial client wants to see runway, right? Yeah. They may be able to refi at some point within the term, but I think those loans will continue to get stickier and stickier, and because of the major banks don't want those smaller loan sizes, there's just less opportunity for that client to go elsewhere. Yeah. So you got to create stuff that, specifically for those clients that they're not taking advantage of somewhere else by paying high double-digit rates.
Makes sense.
Yeah, we're going to start wrapping up here in a minute, but a lot of the buzz here today has been on different things around regulatory, but still a lot of optimism on the future for the alternative and private lending space. So can you kind of speak to that? Where do you see the future going, Mike?
I don't know. I've been here for about an hour before I came over to see you guys. There's a lot of optimism. Yeah. I don't share some of that optimism with general market factors. But what I will say is, to your question about the alternative market, I think there's some new lenders in the market. I think there's some lenders that do a great job, but I also think there's some other lenders that aren't lending. They're originating. And to me, that's a big difference.
Sure.
So I think there's going to be a bit of a shock factor as we get deeper into some of these economic headwinds. But the lenders that run a good shop, they'll remain. And some that don't, may have some tough times ahead, which will only benefit the well-run, disciplined lenders.
Could you break that down a little bit more? Like in the lending companies that you feel maybe overlooking some of the things they need to be concerned about and are focused just on origination, like you're saying, what exactly do you mean by that?
Well, there's one thing, and I think you and I touched on this before in a conversation, but there's one thing that I don't believe. And it's this, I guess as a general statement, I believe, like the credit quality in the alternative, private lending's getting better. Yeah, I agree that because you get to follow. But the whole FICO conversation, to me, people aren't looking at it correctly. Because what we see is we see a 750 FICO come in, but that client took a private mortgage out 4 months ago to consolidate all the debt. So what was the FICO before then? Because to us, that could be an inflated FICO. So that 750 could be on a run rate like a 640. So I just don't want people getting blinded by the FICOs. You got to look a little deeper. What were the last couple transactions on the real estate? You don't want to lend on a FICO pop. You want to really understand the long-term performance of the client.
Yeah. Interesting.
You want to go to the last one before the bonus? Just on...
the future of private lending?
No, about doing something different or what would you change?
Oh, yes. Sorry. So for the first 100 episodes, we asked a question about what was your favorite thing about the mortgage lending space? And everyone said the people. And so we said, we got to switch this up because we got 99 of the same answer. So now we ask, what do you think would be best to change, or do you like the least in the mortgage space?
I like the way you changed that up. No, all kidding aside, I think the barrier to entry has to be higher.
Love that answer.
I think
100%.
I think education needs to be higher. I think just general experience and oversight, right? I think the provincial regulators are doing a great job, but they're doing what they can, right? And I think it's up to all of us in the industry to find ways to push everybody up in the knowledge and the understanding. But I think the barrier to entry is pretty low at the moment.
Completely agree.
In summary, the people. So it's like everyone likes the people the most, but then the biggest problem is the people.
Yeah, too many of them.
But I also think too, this isn't going to be a popular comment, but this is a great event today, and you walk around the show. We also still have to remember, mortgage is debt, right? And although all of us make money, providing the debt stack, sometimes it's okay to say no to a deal.
Yeah.
If it doesn't, you really have to look, is it suitable for the client? And sometimes I think that line gets blurred quite easily.
Definitely. Yep. So focused on closing.
Yeah. Well said, Mike. Time for our bonus question to wrap up, okay? So I want to circle back to your brother playing pro hockey. So obviously, did you grow up in the GTA?
I did, yes.
Okay, so are you a hockey fan now as well, or?
I am, yeah.
Leafs guy, or?
Yeah, I am a Leafs guy, yeah.
Okay, so.
I mean, I'm a Leafs guy between October and May.
And then
when
they get eliminated in the first round?
Yeah, exactly, and then it switches,
sure.
But yeah.
Yeah, fair enough. Okay, so how are you feeling? Obviously, Leafs lost a big piece in Mitch Marner this year. Going into it, the first year without their core they've had for almost 10 years now. Are you feeling optimistic about the changes? Are you feeling nervous? Is it going to be a better team in the playoffs, or where are we going with that?
I don't know. I'm not gonna commit on this one, but I will say, you know who does look good? The Canadians, the Montreal Canadiens.
That pains me to hear, man.
So I don't think I've ever said that before.
I don't disagree.
I think my father would be turning over in his grave, but I think they look good.
They've got some young stars coming up.
But I think the Leafs will go a little deeper this year, but they in my view, they don't have the horses to make it happen.
What level did your brother play?
Well, he played AAA all the way up, and then played junior, Tier 2 junior for Aurora, and then went 1 year at university, and then moved over to the UK. One of his old coaches were coaching over there, and
that's awesome.
We didn't even know it existed in the UK, but it's got a pretty good following. So
and
a lot of Canadians end up there.
You get to follow him for a couple of years there, it sounds like.
Yeah, he's still there. I go back every couple of years. So right on. But yeah, it was a great experience. That's experience.
Awesome. Thanks so much for today, Mike.
Thank
really
you
appreciate
guys.
you coming on. Anything else you want to add on Glass Lake?
No, just say you guys are doing a great job, and thanks for having me.
Thanks so much.
Thank you.
Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp. and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
and your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan McNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.